Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's show, James Dunn of the Switzer Report shares his 4 stocks under 40 cents. James is pretty good at picking these cheap stocks, so I'm looking forward to seeing what stocks he's come up with. And then Bogdan, who is the portfolio manager of the Switzer Dividend Growth Fund, which specialises in finding stocks that pay good income. He'll give us 3 stocks that are often under the radar that people don't see, which are really good income payers. And then we've got poor Rickard, who's looking at the reasons why Telstra's share price has spiked. And we asked the question, can it keep on rising? Apparently the analysts are very positive about Telstra. And then we have a property lawyer who's basically an expert in real estate, who's telling people don't buy new apartments. You'll see why later in the show. So that is the show ahead. Let's go to James Dunn for 4 stocks under 40 cents. Thanks for joining us on the program, James.
A pleasure, Peter, as always.
Now, you wrote a really interesting story, and a lot of people have commented on it in the Switzer Report, 4 stocks under 40 cents. Now, I've purposely haven't actually read it so I can be enthused when I hear you explain the companies in question. So let's kick off. What was the first company?
Well, the first one was MicroX, which I've looked at in the past, I have to admit, and it's taken a while to get going, Peter. It's actually a really good advanced manufacturing story in Australia. It's diagnostic equipment, but they've made a real breakthrough in X-rays with what they call cold cathode carbon nanotube. And if you look through the company, then the code is MX1, and the company's called MicroX. So I'd encourage people to look through all of their announcements and annual reports on the stock exchange. Look, they listed back in 2015 at 50 cents and they went to 57 and they've been as low as 12. And so when I wrote the article on Monday, they were 32. And we often say that one person's share price fall is another person's opportunity. And I think this is one of those scenarios where if you read through their stuff, and it's pretty interesting, they say that X-rays really haven't changed much since Röntgen invented it back in 1895, and most of it's with a heated filament. They've got a cold cathode tube technology, which is far lighter, smaller equipment. So they've got some interesting contracts both with defence forces and military and security and police, not just healthcare, because they can use the X-ray in healthcare applications, but also, for example, in a security screening system that's mobile and lightweight for use at airports or bus terminals or anything like that. And they've got some contracts with the Department of Homeland Security in the US. So they've got several different markets, Peter, and the really great thing about it, if you look at this, is that the cathode tubes are manufactured in Adelaide. So it's advanced manufacturing in Australia, which we always like to see.
Yeah, it's a great story. You got to keep your fingers crossed. All these companies are always speculative, but this is in a real area making stuff, and it sounds like an interesting company. What's the second one, James?
Tieto Minerals, TIE, which is a gold project developer, but in the Côte d'Ivoire, the old people might know that as the Ivory Coast in West Africa. So look, there's quite a few companies on the ASX that are focused in West Africa, and you know, you do have some political risk in countries in Africa and other parts of the world, but look, sometimes you have it in Australia, but we certainly don't have rebel groups like they have in parts of Africa. I'm not saying Tieto Minerals does have that. Côte d'Ivoire, the Ivory Coast, is relatively stable. And look, they've got a gold project called Abuja, Peter, and they've returned some spectacular high-grade intercepts. They're moving into development of the mine, front-end engineering design. They're starting to build the site and the camp and all of that. They don't yet have final approval from the Côte d'Ivoire government, but reading between the lines, they've got everything else. And with those high grades, they've got a relatively low cost, about $839 an ounce. At present, gold's trading at $1,800 an ounce, so around about. So they'll make a fair bit of money, pay back high grade, so they'll pay back the spending relatively quickly and hope to expand the resource with further drilling.
And I guess over time, even though you say the gold price is high, the outlook with eventually the strong growth leading to higher inflation, that's usually good for the gold price as well. So down the track, this could be an interesting play. What's the third one, mate?
The third one is Spirit Technology, which a lot of people would see quite big advertising for at the moment. I believe just outside Sydney Airport, certainly on the Melbourne, the M1 freeway. And Spirit Technology, it used to be Spirit Telecommunications, and that's really what they did. They were mainly an internet NBN style provider, but they've made some big acquisitions in recent years and really exited consumer businesses, certainly the residential internet provider business. They got out of that. And they are now really arranged to service small to medium-sized businesses and government departments and corporates, organisations such as universities with their high-speed internet, mobile, voice, cloud, cybersecurity, and managed services. And when you've got all those offerings, Peter, you're able to bundle them and create quite attractive pricing. And this brand, Spirit, which now that I've mentioned it, I bet people see it because they're advertising quite heavily nationwide to build their brand. And I think it's got a pretty promising growth outlook from here, Pete.
If you think about the history of small telcos, invariably they've started by actually focusing on SMEs and realising that the big boys don't look after them as well as they want to do. And they often have created some great niches for themselves.
Well, that's right. And in things in particular like cybersecurity, that they bought one of the acquisitions. They've made 7 or 8 acquisitions over the last 4 or 5 years, Peter. And they're all, look, there often is, we often use a phrase, integration risk. And sometimes when you're bringing other businesses under your umbrella, they can take a while to bed down, but they're going pretty well with that. And they're expected to be profitable at 30 June, which was, of course, yesterday. We won't find that out for a while. But telecommunications equipment company NextGen, that was their most recent, I think that's their biggest acquisition, and that's going to be a big driver of revenue growth.
Yeah, that's a well-known company. All right, mate, let's go to your fourth one.
Well, we're all talking about materials of the future, and the ASX does have quite a few lithium and other kinds of stocks, and we've been writing about them recently in the Switzer report, Pete. This one, Ioneer, INR is the code. It's got a very advanced lithium project in the United States at Rhyolite Ridge in Nevada. But the beauty of this is that the deposit also contains boron, and they'll create, as they get the lithium carbonate out, they'll also create boric acid, which is an industrial input. And what they receive for the boric acid, they postulate, Peter, that that's virtually going to pay for the cost of getting the lithium out of the ground. So the boric acid, which they've pre-sold quite a bit of it in Asia, it will, if it doesn't pay for it all, it'll certainly put them in the very, very lowest, down the bottom of that curve for cost of lithium carbonate production. So look, Joe Biden's plans have, he wants the US to have its own supply chains in these crucial metals of the future, like lithium carbonate. And so it's a good time to be bringing on a very cost-effective lithium project in the United States. And look, this week, Pete, they signed a big offtake agreement with EcoPro of South Korea, which is the second largest maker of battery carbonate materials in the world. And that's going to take they'll take about a third of Ioneer's annual production when they get started. But that's how these companies build their revenue. They sign offtake agreements, and so they know by the time they get to full production, they're not selling it in a market where they're holding it up and asking people to bid for it. They have pre-existing offtake agreements that really underwrote the whole project, and they know where their materials are going.
James, thanks. That's 4 great ideas. For people who want to read more about what James' analysis says, have a look at the Switzer report. James often comes up with some great ideas and people have made money as a consequence of it. Thanks for joining us, mate.
A pleasure, Peter. Anytime.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer or click on the link in the description below. Joining us now is the Portfolio Manager for the Switzer Dividend Growth Fund, Marcus Bogdan. Marcus, thanks for coming on the show.
Thank you very much, Peter. Terrific to be here.
Yeah. Now, one thing I want to say to you is, I'll ask you about, are you surprised how well the stock market is doing, considering we've gone through the tax selling month of June and you've got lockdowns that taking nearly half the country? It is a bit surprising the market keeps on going up.
It has been an extraordinary recovery in the share market over the last 12 months. The ASX 200 is up around 23%. But I think critically, that is underpinned by what we're seeing in the recovery in earnings. And so for FY21, August reporting season is coming up very, very shortly. The expectation is around earnings growth of 25%. So I think the market and the participants are looking through these short-term lockdowns and seeing where those upgrades in earnings are coming from. It's coming from the resource and banking sector, which are absolutely 2 pivotal components of the ASX 200. So I think in the short term, I think the fundamentals are absolutely justified. Yes, there are a range of challenges that we've got to look at, but then I think that's important in terms of how we construct the portfolios.
Yeah. Well, I want to get back to the actual fund later, but before we promote something I've got a link to, let's give away some good information first up. I've asked you to look at 3 stocks, lesser known stocks, unlike the banks, that actually are very good income payers. So what have you come up with, mate?
So it's important that we want to have consistent dividend payers. And so the 3 that I've come up with are Medibank, Spark New Zealand, and Waypoint. Medibank has actually done well through COVID. They've grown market share. The participation rate in terms of private health insurance has improved, and they are the market leader. And they have been able to consistently deliver a strong dividend. Expectation is that dividend yield will be 4%. Fully franked, and we believe that level of dividend is sustainable, and importantly, you're getting underlying growth in that business. The second business is Spark New Zealand, which is really the former state telecom company, the Telstra of New Zealand. That has been a very consistent performer in that market. The industry structure is actually better than Australia. And that's been able to deliver very consistent dividends. It's upgraded its dividend guidance to the upper end of its guidance recently. And we expect that they can deliver a sustainable dividend yield of around 5.2%. And the last company that I'd like to talk about is Waypoint REIT. They own a number of service stations in Australia with Coles Express on them. They have very long leases. The average lease is around still 10 years. And it's got 3% escalators, so that in each year that income can grow. And they provide a very attractive dividend yield of around 5.9%. So they're three of the lesser known companies that we're looking at that we feel that can deliver consistent dividend for our investors.
So Waypoint then is fully franked, or is it?
No, it's a REIT, so it doesn't have the benefit of franking, and that's why the underlying yield of 5.9%.
Yeah. We should explain to people that a REIT effectively doesn't pay tax like a normal company. So as a consequence, it doesn't have the benefits of franking credits.
No.
Yeah. Okay. And the Spark one, of course, is New Zealand based, so they're not paying tax here in Australia. So once again, there's no franking benefit.
Yes, but listed on the ASX 200.
Yeah, okay. So we've looked at your. Now, we actually talked about what's going on with the stock market this year. What do you think is going to happen in the year ahead?
Well, I think what we've seen in the last month or so is that we've got significant cross currents occurring in the market. Earlier the year, there were really clear themes, and the clear theme was the recovery in value compared to growth. But in the last month or so, given the complexity that we're seeing in the world, some areas growing very strongly, we've got lockdowns here, that tilting between styles has become more complicated. So we think that there's a three-pronged approach to portfolio investment in the coming year. In the first instance, we do want to be exposed to those companies that are generating really good upgrades in earnings. And we've mentioned those, and that is in the banks and resources. They'll pay very attractive dividend yields. The resource companies are been very disciplined on CapEx and providing capital back to shareholders. That's the first area that we want to be invested in. The second area that I think will continue to do well are those consumer staple companies that even when we've got lockdowns continue to perform strongly. So Woolworths, Coles, and more recently Endeavour, which we've added to, which is a spin-off of the retail liquor business and the hotel business out of Woolworths. And the third area is that ultimately we will recover. The economies will reopen in Australia. And so we want to be exposed to some of those potential beneficiaries. And they're companies like Ampol, CSL and Ramsay's that should do better in a more normalised economic environment.
Well, Marcus, we've looked at the past, we've looked at the companies that you like right now. As you pointed out earlier, 24% gain for the stock market last financial year. What is your conservative guess of what this market can do this year, this financial year?
Well, I think what is critical, and when we're looking into this new financial year, is that the momentum that we're seeing in earnings and earnings upgrades continue. So the consensus forecast is for FY21 results coming up in August of earnings growth of around 25%. And then for the new financial year where we've started today, the expectation is around 12% earnings per share growth. Now that should translate into maintaining the valuations that we've got today, but also translate into growing dividends for investors. And I do think that interest rates will stay near rock bottom levels, and an average dividend yield of around 4% for the market compared to a cash rate of 0.25% still provides the impetus and the interest in markets. I do think we've had that big hockey stick recovery in markets. We'll see a period of maybe greater consolidation. There will be areas of volatility given the nature of what we're seeing in markets and the uncertainties. But I do think that the markets overall are underpinned by strong economic fundamentals.
Great stuff. Thanks for joining us, Marcus.
Thank you, Peter.
Well, a stock that Paul, Rickard and myself have liked for some time, Telstra, had some good news this week, and the share price has taken off. Let's just see if this takeoff can be sustained, and let's get behind the news story, Paul.
Yeah, Telstra's done pretty well, Peter. It's been going up pretty steadily now for the last few months. Close today at $3.76, and that's on the back of the news yesterday that it sold 49% of its towers business at a price that exceeded most of the analyst forecasts. In fact, it took the analysts by surprise because Telstra had sort of previously indicated the deal wouldn't be done till the end of December. The fact that it was done on 30th of June, that was all very positive. Plus, Telstra said that they'd return approximately half back to shareholders by some sort of capital action, most likely to be an off-market buyback later in the year of about $1.4 billion. And so that's positive, and that's worth about 12 cents a share. But if done in terms of an off-market buyback where only low rate and zero rate taxpayers will participate, that's good for everybody. So the market took that as a positive at $3.76, Peter. It sort of reached the target that both you and I had some months ago when it was down to the threes. We said about $3.70 at the time, I think, from memory.
Yeah, but and of course, some people said, well, can it get to 4? And both you and I at that time thought, well, that could be a really hard benchmark to achieve. Would you be prepared to say, given this, it might actually start heading towards 4 over the next year or so?
Yes, I think it's possible, Peter, because the analysts are now pretty bullish on Telstra, which is, look, they've sort of been right the last 6 months, I guess, but a number have raised their target on the back of the news yesterday. So we've now got some brokers as high as $4.25, as I think there's might even be a $4.40 target out there. So I don't think $4 is out of the question because, it's still going to keep on paying its 16 cents dividend yield. That looks pretty secure. And I guess it's in a market which is low growth, but also not just low growth, but it's also a very stable market and a lot less competition now that sort of TPG, who was the big, big competitive force out there, has got together with Vodafone. And it looks like the Vodafone guys have won. And we're now back to not an oligopoly, but whatever you call 3 major players in Telstra, Optus, and the merged Vodafone TPG. So not much competition, opportunity to get some margin back. And I probably in that environment where you're still getting a 16 cent a year dividend, which is a reasonable dividend yield, fully franked, very hard for a lot of income investors to want to sell. And I guess that means there's more upside. So my own point of view, I think we've seen a lot of the rise. I think, 2/3 or so is at least already behind us, but still a little bit of value for those that haven't been on board the Telstra bandwagon.
Well, Paul, I'm putting you on the spot here, but you usually do this sort of thing. Have you worked out what the dividend yield would be on 375?
Well, I'll do it very quickly, Peter. On $4, it's going to be 4%. So on 375, it's going to be about 4.25. So
plus franking.
Yeah, that's pretty close. Plus franking. So and that takes it up to almost 6%, which when term deposits are at 0.3%, and you don't have a lot of downside risk on Telstra, it's not a very volatile stock. I mean, obviously it's an equity, and we've seen it trade in a range over the years between $7.50 down to $2.50. So there's not as though there's not much risk, but it's not the most volatile of stocks. And for many income investors, that still looks pretty good. I mean, the big issue with Telstra going back over the last couple of years, Peter, could it maintain its 16 cent dividend? I think now the market's pretty convinced it can, and this sort of return, which will reduce the share base when it happens, that's an ongoing sign of confidence from the management as well, that they think that 16 cent dividend looks pretty secure.
If you look at the potential problems for Telstra out there, Paul, Are there many? And if so, even if it's only a small number, what is probably the biggest risk to Telstra's very comfortable looking position right now?
Well, I guess the biggest risk is still some sort of competitive action. So I mentioned it's whatever you have when you have three players together, but occasionally, occasionally, a bit like we saw on the supermarket. We had with the supermarket wars between Woolworths and Coles and Aldi and others. You get some sort of irrational pricing. So that's risk number one, that really the competitive forces pick up in that whole mobile and broadband space. I still think it's ongoing arrangements, and what its role with the NBN long term is still a bit of a risk. And then the third risk, Peter, is that to actually maintain that dividend of 16 cents, it still needs to grow earnings. And what we've seen with Telstra so far has been able to sort of cut some costs, but really hasn't been able to pick up its revenue. So I still think, there's still some work to do for Andy Penn and his team actually to get the sort of underlying earnings a little higher to be able to sustain that dividend over the long term. So that's, I'd describe as the risk. I don't think any of that particularly high at the moment, but obviously, it's got general market risk. If the market wants to sell off 10%, then Telstra will sell off by probably not 10%, but at least 5%. So you can't ignore the overall market risk of any stock market investment.
Okay, Paul, thanks for joining us on the program.
Thanks, Peter.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, I'm talking to Cathy Sherry, who is an Associate Professor at the University of New South Wales Law and Justice. Thanks for joining us on the program, Cathy.
My pleasure.
I must admit I was intrigued when I read a story in the Sydney Morning Herald that you penned. Of course, we don't pen anything nowadays, we type. And you made a point following the collapse of the apartment block in Miami that, that we possibly here in Australia have similar challenges that are either going unnoticed or unsupervised. Can you just sort of explain to us the link between what happened in Miami and what you think is going on here in Australia?
Yeah, well, I suppose the first thing that needs to be said is we don't know yet why that building fell in Miami. There'll need to be a report. There does seem to be a suggestion that the building was in need of quite serious maintenance, which hadn't been done. You also only have to look at a photograph of it to wonder about the land that it will, I say land in inverted commas, the land it was built on. It's literally on sand on the seafront and it's reclaimed land. But we don't know. But one thing we do know for sure is apartment buildings, high-rise buildings don't routinely fall in the middle of the night in first world countries. So they do fall, but usually as a result of earthquakes in countries that don't have building regulations or strong building regulation. So it's really very, very disturbing. I was concerned about it simply because I research apartments, and it's always heartbreaking to see that kind of thing happen, same as the Grenfell disaster. But a number of years ago, I was doing some research on long-term management contracts in strata schemes. So they're the kind of management contracts that bodies corporate often find they've been bound by the developer. And I was looking at the United States because this is where we've copied a lot of our building from. So a lot of the master planned estates and high-rise buildings we have in Australia are kind of copied in form from the US. And I had read a report that was written in 1975 that was done by the US Federal Housing Authority. And it was a report that was done as a result of huge problems in the condominium industry, in particular in Florida. So there'd been a massive boom in condominium development in Florida in the 1960s and 70s. Huge problems with development, amongst other things, building defects. Reading this report, it really struck me as that it was like Groundhog Day. Everything the report was describing were the same kind of problems that we see in our strata industry. So all sorts of nefarious practices by developers that purchasers get caught out by, and they included building defects. And I wasn't writing about building defects at that point, but when this terrible tragedy occurred in Florida, it occurred to me, well, everything else that Florida experienced in the 70s, we experienced, have experienced recently. We could be in for the same kind of danger. Particularly in relation to the role that not maintaining buildings will play in them perhaps becoming dangerous, and especially buildings that had underlying defects. And you only have to have read the paper in a cursory fashion to be aware that strata schemes in Australia have very serious problems with defects. So many purchasers have purchased a new apartment only to find that they are now the co-owner of a large high-rise building that has extremely serious building defects, and it's up to them to fix it, which is often a very difficult, if not impossible, ask of ordinary homeowners.
Cathy, has this always been a problem in Australia, or is it something that developed in recent times?
Building defects, you mean?
Well, the magnitude of building defects.
Oh no, it's a much more recent problem. So I mean, reading, there's been multiple reports. I don't spend an enormous amount of time doing research on building defects. One of the reasons is it just actually makes me so annoyed. I find it difficult to work in this area, but certainly reading the reports that have been done so far, there are a whole range of reasons why we have real problems today. One of the key reasons that people keep coming back to is private certifiers. So in 1998 to 2000, leading up to the Sydney Olympics, the law was changed so that private certifiers could sign off on designs and also occupation certificates for buildings. Prior to that, it had always been done by government, it had always been done by local councils. And I think that there is widespread agreement there are enormous problems with that system. So enormous problems with private certifiers being underqualified, but also because of the very obvious conflict in interest that they are being paid and employed by the same people whose building they are being asked to approve. So there are very, very real problems. A number of reports have identified that. So it certainly buildings have had defects in the past, but nothing of the magnitude that we've seen in the last 20 years.
The apartment block in Homebush, I think it was Opal Towers, is that right?
Yes, yeah. Opal Towers, yeah.
Was that the first of its kind on that magnitude?
That I'm aware of. Yes, of that large scale building, yes, that I'm aware of. And there's one in Mascot as well. But again, the reasons for some of those defects are not clear, and I'm not going to make any statement about what I think the reasons are for those problems. But I suppose in terms of, there have been problems with defects in buildings before. I mean, one of the modern difficult challenges we have is that very, very high-rise complex buildings are a modern phenomenon. So we had apartment booms, obviously, in the 1970s, and apartments were built all through the 1980s and 1990s. But these very large, very large scale, very complex buildings are a much more recent phenomenon. And so when there are problems with those buildings, it's actually much more complex than fixing problems in a 3-story walk up. But to my knowledge, in history, I mean, I've never been aware of the fact that there were enormous problems with building defects, for example, in the 1970s apartment boom.
So if someone is sort of contemplating buying a new apartment, what would be the advice you would give them?
Don't. It's as simple as that.
Yeah.
Anyone who asks me about apartments, whether it's friends or family, and I know of many people who work in the strata industry as lawyers who would say exactly the same thing. If you want to buy an apartment, don't buy a new one. It is that simple. Building defects are so widespread. I mean, you can employ a good strata lawyer to do searches for you to find things out. Personally, I would never take the risk. If I was going to buy an apartment, I would buy a 1970s or 1980s apartment, 1990s. I mean, a beautiful 1930s Art Deco one would be very good as well, but they're quite expensive and there's not many of them around. But I would say to anybody I know, do not buy a new apartment in Sydney, because you will be paying a premium for a brand new apartment. You're definitely paying a higher price because it's brand new. And there is a strong possibility that you will be buying into a building that has defects of a whole range of varieties. They might be minor, they could be very, very serious. But ultimately, there's a very strong likelihood that you as the purchaser will end up being responsible for them. You won't be able to sue the developer and you won't be able to sue the builder because you have no contractual relationship with the builder and because the developer never made you any promise that the building was defect-free. So my very strong advice from what I know about the strata industry is just don't buy a new apartment.
Okay. Is there insurance available for someone who buys a new apartment and wants to be protected against an enormous defect bill coming, which will be shared amongst all the owners of apartments in the block?
No. And there's a building, the New South Wales government in the last round of strata approvals introduced a building bond, a bond system where developers have to pay bonds. I'm not sure how well that is working. People I know in the industry suggest that the proportion that developers are required to pay in is not sufficient to cover serious building defects.
Yeah. Do you think this is a problem for inexperienced developers, or is it something that also is a problem with well-known, highly respected developers?
It's hard to say. One of the things that's quite difficult in this area is getting information. There are certainly academics. I mean, I would recommend the work of Dr. Nicole Johnson, who works at Deakin, who does quite extensive work in this area. But actually getting information like that, I mean, certainly there is information about building defects available, but a lot of people in the industry and owners themselves have an interest in things not being as public and as transparent as they could be, because of course people have invested a lot of money, people don't necessarily want the public to know how widespread the problem is. I don't think I could give any generalisation about whether you're safe buying from a particular one developer rather than another. Certainly the New South Wales Building Commissioner is a vast improvement and he seems to be doing extremely good work. That's certainly a great step forward. But government thus far has been extremely ineffective at dealing with building defects in the industry.
Do you think we should go back to a regulator version of certification?
Look, it's hard. I'm not a construction engineer, so that's one of the difficulties. I'm kind of slightly reserved about certainly making recommendations. The one thing I would say as a property lawyer is that developers have been able to get away with this because they're allowed to sell a product that's defective. It's as simple as that. Developers don't make any money until they can settle a sale. And the reality is the law has allowed them to settle sales of defective buildings. If the law can be changed in a way that a developer cannot settle a sale, that is, cannot get their money until it is clear that the building is defect-free, then we will certainly see some kind of improvement in building defects. Developers will find ways to ensure that it doesn't happen. There's been all sorts of recommendations about how to fix that. That's my feeling as a property lawyer, is that the reason why it has continued to happen is that if you can make money out of defective buildings, you will continue to do so. We need something to stop developers being able to sell in the first place, and all manner of disclosure and bonds and all of those things. It does seem to me slightly that, it's not going to result in fundamental change as long as developers can continue to sell buildings that are not clearly free of defects. And the answer also, maybe to be more specific, is the answer is most certainly must come from government. I think that, these are much, much bigger political issues that we've been facing in the last 30 or so years, but the conviction that somehow government is always inefficient and it does things better and the private sector would do things better than government, I think, in many areas is manifestly untrue. The pandemic itself is a good example of this. There are certain things only governments can do. In the context of the pandemic, only governments can have shutdowns, only governments can mandate mask wearing, all of those things, only governments can roll out vaccine programs. And in this area, and there are other areas of property law that are like this, there are certain things that it really is simply better that government does and does properly, and we don't rely on the private sector to do it.
So is there any government around the country that is seriously looking at making developers be accountable for their apartments if they have defects?
Well, the answer is the government can do it. I mean, one of the things I sometimes say in the area of property law that I think sometimes people forget is state governments in Australia have plenary powers, enormous powers, subject to limitations from the federal constitution, which are not relevant in this area at all. State governments in in Australia can write any laws they want to write. It's just a question of political will. It's as simple as that.
So but at this point in time, no state government or territory government is interested in actually protecting consumers buying apartments.
I think they are interested. I think they're continually talked out of it by various sections of industries that have vested interest in this not happening. I mean, again, I'm not a construction lawyer. I think there are a lot of complexities in this area. There's no doubt about it. But I keep coming back to the fact that we have in the past been perfectly capable of building buildings without major defects. And we apparently appear to not be able to do that now. It's not like it's physically impossible to build a building without a defect. It is possible. It's just a question of whether the law crunches down on people who do otherwise.
Cathy, thanks for joining us on the program.
Thank you.
Thanks for joining us for the show. Clearly, we have been influenced by the lockdown in Sydney, and we've got another week to go. So we will be doing it in this unusual way, but the content's still the same. Top quality people who know a real lot about investing. If you want to know more, have a look at the Switzer Report, switzerreport.com.au. Once again, thanks for joining us. See you on Monday.